Welcome to Latrobe Financial's Development Finance webinar. My name's Corey Bannister, Chief Lending Officer here at Latrobe Financial, and I would like to extend a warm welcome to you all. With over 1,100 registrations, development finance is clearly a hot topic for you all. We thank you for taking your time out of your business to learn more about us here at Latrobe Financial, development finance generally, and to hopefully learn how we can help you in your business. We certainly encourage you to post any questions you may have throughout the webinar, and we'll attempt to answer them if time permits, and if not, we'll certainly respond to you separately at the conclusion of this session. Property development in Australia has been subject to plenty of media coverage recently. We've got the potential oversupply issues, the supposed impact of foreign buyers on house prices and the subsequent duties and taxes being applied. We've seen restrictions on property investors, and all of this has really led to a tightening of credit that's resulted in either projects being delayed or shelved completely, or developers are seeking alternative finance arrangements. And it's this tightening of credit that can actually equal good news for finance brokers by being the go-to resource when a developer's traditional lender says no. Here at Latrobe Financial, we've experienced a significant increase in the level of inquiry for construction development finance and many requests from finance brokers for help on how to deal with these types of transactions, particularly if it's a new area of business to them. And really it was through this inquiry for assistance that the idea to develop today's presentation was born, and we certainly hope it adds value to you and your business. That said, we understand that one presentation is very rarely enough to answer all of your queries, and we certainly encourage you to contact your local BDMs with any additional questions you may have, or feel free to contact our credit team here directly to help fill in any remaining gaps you have after today's presentation. So let's get started. Today we're going to cover on the following key points for you. We're going to touch on construction lending generally, what our program looks like. We're going to take you through some of the key terms you may hear when talking about development finance, what you need to provide us to get a development finance quote. We'll work through some scenarios with you to show you in detail as to how we can work out what the transaction stacks up. We're going to show you a funding table. We're going to explain a feasibility analysis. We'll explain our process to you, what document requirements there are, how you ascertain serviceability, and what you need to do next to start writing this business. So really our aim today is to remove some of the mystique associated with development finance and to hopefully build your confidence to a level where you yourself can give it a go. So without further ado, it's time to hand over to our resident expert in all things construction development finance, Mr. Steve Lawrence, who's Head of Credit here at Latrobe Financial. Steve has an exceptionally strong reputation for credit skills in this area of finance, built over a long career in banking and finance, this being his 40th year in the industry. Steve's held senior operational and lending roles in substantial organisations in London, Sydney and Melbourne, including Reliance Bank and Prudential Assurance Company Limited in the UK, Australian Bank in Sydney, Advance Bank Australia here in Melbourne, OCBC and Westwater Property Group. Steve's established and managed mortgage origination programs and credit departments. He's underwritten and managed $300 million corporate credit facilities and underwritten substantial commercial loans of up to $45 million in size. He also has significant experience in the management of delinquent loans and management of our mortgage book portfolios. Steve successfully managed our construction and development finance portfolio here at Latrobe Financial and has been a key part of the product development and portfolio management functions in this area. So without further ado, I hand to you, Steve Lawrence.
Thanks very much, Corey, and welcome everyone. As we've said, we just want to go through construction lending today, and I suppose the audience today, is going to be varied in experience from those of you who have probably never undertaken a construction loan before and just want to learn a bit about it. I suppose to those of you who are fairly new and maybe have just dabbled in the construction side at the moment, very small types of deals. And of course, those of you who are experienced and understand this type of lending in a bit more detail. So for those of you, I suppose, who haven't dabbled in construction lending or I've only done a little bit, what I'd like to do today is just start off with just going through some key terms for you, just so when I go through the presentation in a bit more detail, you'll have a little bit more of an understanding of those key terms. So, key terms, here we go. Developer. Well, the developer, of course, is going to be the person who is actually going to develop that site at the end of the day, the property, depending on what, of course, it's going to be. Some developers will start on construction, maybe 3 or 4 units, very small. Development lending, we regard as construction of 3 units and above. The developer would be the borrower who owns the land, wants to do the construction. The borrowers normally, we find for multi-unit construction deals, the borrower is normally a company, a special purpose vehicle that has been set up to specifically look after this specific development of the sponsor behind the deal. So what we find is we don't normally undertake individual construction borrowings, as I say, to individuals, but we do through companies. And you'll find that the actual person behind the company, director, shareholder, is the actual sponsor who will sit behind this borrowing company. The builder, okay, we deal with builders of all sizes, smaller builders, of course. At La Trobe Financial, we lend money to developers who have a third-party builder doing the build for them, but we also lend money to builders who are actually developing themselves at the end of the day, as long as it's for investment purposes. And those builders have to be, of course, qualified, hold the relevant licenses, the domestic building unlimited or the commercial building unlimited type licenses. And those builders are normally vetted by our quantity surveyors. Another key term we use is the on-completion value. Now, the on-completion value is the value of the properties that you are building once they have been built. They're the on-completion value. So a developer will normally have a rough idea of what the end value of the properties are going to be once they've been constructed. With regards to new stock that's been built, it is the GST is actually applicable on this stock. So when a developer sells the stock, they have to pay GST to the government. And that's the 10%, or could be a little bit less if the margin scheme's involved, and I'll go through that a bit shortly. So the on-completion value is the estimated market value of the properties that have been built. Move on to the as-is value. As-is value is the value of the land on a highest and best use basis as a future development site, and that is without a permit attached to the site. So it's just a plain as-is value valued as a future development site, and the valuers will value. So, for example, if you paid $1 million for it, and the valuer will value those property without the permit attached and say, yep, this is a highest and best use future development site, and that's what we call the as-is value. A project-related site value, on the other hand, is where the specific permit that is attached to the site is taken into account. So, for example, if they're building a 6-unit, a 6-townhouse construction site, the value will take in the value of the properties that are being built, the estimated value at the end. They'll take all the costs off. A profit margin will be involved, and then the end value is called the project-related site value. So that is the value of the land with the specific permit attached to that land. With regards to total development costs, what we mean by that is the purchase price of what they paid for the land originally, what it cost to build, what it cost to get all their consultants involved, for example, architects, engineers, surveyors. We include interest that you're going to have to pay on the finance, your upfront finance costs, all costs regards purchasing the property, etc. So this is total development cost. That is the total cost that it will be to actually build the site from the beginning of purchasing to the end when you've completed construction. The next key term is feasibility. When when you go and speak to a developer at the end of the day, they would have already done a feasibility on the site. Is this going to be if this is going to be a profitable deal for them at the end of the day? They should have already done a feasibility on the site. How much can I sell them for? How much is it going to cost me to build? What other costs do I have involved? And then they'll work out, is this going to be profitable for me? So the feasibility, we'll go through a feasibility view one a bit later, and that will also take into account the profitability. Now, profitability, that is the profitability is the developer's going to make from what they sell it for to what it's going to cost. And at La Trobe Financial, we look at a minimum 15% profit margin. You have to make minimum 15% profit margin for us to look at the deal. What you'll find in the market normally is profit margins can range from around 15 to 25%, depending on each type of deal, large or small. But again, with La Trobe, and I think you'll find in most other institutions that the minimum profit margin would be 15%. Capitalised interest. All construction loans at La Trobe Financial, and I think you'll find everywhere else as well, includes capitalised interest in the loan amount. And that is what we do is, and I'll go through an example shortly, we make sure the interest for the loan, the term of the loan, is covered within the loan amount. And the reason, of course, we do that is if we let borrowers say, yeah, we'll pay the interest ourselves, if a borrower at the end of the day doesn't pay the interest, of course, we're going to have to take possession ourselves of the property and finish it off. So what we do is we include within the loan amount capitalised interest. So there's no issue at all during the term that interest is going to run out or not be paid. Pre-sales, very, I suppose, popular or typical at the moment in the market with regards to the banks. As we know, a lot of the banks currently want 100 to 120%, if not more, of their loan covered via pre-sales. Now, these pre-sales is the developer pre-selling some of the the properties that will be completed prior to obtaining the finance. So, for example, if we have a loan of 2 million, banks will be looking anywhere from well over 100% of that to be covered by properties that you have already sold, pre-sold to people. A main example of this, of course, would be some of the large apartment development sites, say in the major city locations. A lot of the developers would have had to pre-sold those to whether they be locals or from offshore before the bank or the finance company would be at all interested in lending them the money, because at the end of the day, they want to make sure that when construction is completed, those pre-sales will settle and they will get their money back at the end of the day. La Trobe Financial is willing to look at a little bit of a lesser pre-sale levels than the banks, and I'll go through that with you shortly. When it comes to the quantity surveyor, now quantity surveyor reviews the building contract that is issued by the builder that the developer has in place, and they confirm that the construction costs that are noted in the build contract are in line with market at the end of the day. And what quantity surveyors do is, of course, they've got all the costings of all the builds that they assess all around the city locations they're involved in. They look at those build contract and say, La Trobe, if you have to take over this development site, we reckon that the costs are in line with what the build contract actually says. If they're within a 5% range, maybe 5% higher, we're normally okay and the QS is okay to go within that build contract. However, if the QS comes and says, well, actually, I think it's much higher, 10%, 12% higher costs than the actual build contract, then we have to consider, well, we're maybe not keen to proceed unless we can get the builder to review. If they can't, of course, we can't proceed. So QS does that work for us. So as a valuer would value the property, a quantity surveyor reviews the build contract of the builder. And then also give us an overview of the builder. Are they currently licensed? What have they previously done? What is their track record? Have they got construction insurance in place for this? Is their homeowner's warranty insurance in place? So that's what the quantity surveyor does for us on construction. At La Trobe Financial, if a build contract is 900,000 or greater than 900,000, then we will require a quantity surveyor. If the build contract is less than the 900,000, we're happy to go with a valuer to go out on site, and we go through the 5 stages of build on the normal HIA type contracts. But again, if the build contract is going to be greater than 900,000, we will ask for a quantity surveyor to do a report for us. And of course, the quantity surveyor also goes out during the journey on normally a monthly basis to let us know what work has been completed on site. And so, of course, we can pay the builder to keep the builder going as they're moving forward with the construction. Final key term, residual stock. So residual stock is, we spoke earlier about pre-sales. So this is where you pre-sold some of the properties. They, of course, will settle at the end, but builders or developers don't always sell every property at the end of the day. And they may have 2 or 3. So if we did a 10-unit development, they may have 2 or 3 left over, and that's what you call residual stock. And now some developers, of course, may hold them for long-term investment purposes. Some of them may want to obtain further finance because they can use the security of those investment properties at the end of the day to get some cash out to move into their next development. So La Trobe Financial does a fair bit of residual stock lending around the country. And again, this is for those properties that have not been sold and are remaining once the construction loan has been repaid. So hopefully some of those key terms, there's a lot of key terms here. Hopefully I've given you a bit of an idea about them, and as we go through, hopefully it gives you a bit more understanding as we carry on. Apologies. The next valuers. Okay, valuers, very important part of the process. So what we obtain from the valuer is a long form valuation report. Short form valuation reports, as you all know, are done for home loans, owner-occupier investment, and also for single residential construction loans. But for multi-unit, and as I mentioned, that is 3 and above, we ask the valuers to prepare a long form valuation report, where in that report we ask for the on completion value, inclusive and exclusive of GST. We ask them for an as-is value, a project-related site value, and a profit margin. And of course, they prepare their feasibility for encompassed within their report. They also give us details of comparables all around local areas. And this forms a very important part of our assessment. We use valuation firms, as you can see there, like LMW, NB, Charter Keck Kramer, Optian, WBP, JOL, Savills, major firms who specialise in the larger type multi-million dollar type transactions in the property development area. As mentioned earlier, we also we use quantity surveyors. Very important part for us, as I mentioned above, that $900,000 build-in mark, contract mark. Very important part for us, especially on that construction side. Just to give you an idea of who we use around the country, we use firms like Mitchell Brantham, Charter-Keck Kramer, Napier Blakely, Gray Robinson Cottrell in Brisbane, Ryder Levitt Bucknell. So again, major quantity surveyor firms that we use, and you may come across them. You may already have a valuation or quantity surveyors report on deals that you are currently looking at. So hopefully I've given you a few names there that you may have already seen, but they are the major firms we use for valuations and quantity surveying. Okay, so let's get down now to some of the nitty-gritty of what we're going through today. So you've gone and met the developer, and the developer has spoken to you about what they're looking at doing, building a townhouse or an apartment development, and whereabouts it's located, how many it is. They probably got a copy of a feasibility they might hand to you, estimated market value on completion, what the construction costs are going to be. So you've met with them, they give you all that information, you understand a bit more about the deal. So you go, okay, we've got to get the finance here. So what does La Trobe look for? What do we look for when you come to us with a scenario on a construction loan? So what we look for is basically 6, 7 or 8 main points that I've got down there. And this is all we need to know up front when we do the scenario. So we need to know where the location is. All right, so we probably lend mainly in major city locations. And so we do a very small amount in major regional, but that's a very small amount. The most amount of lending we do is in the city location. So we need to know where that location is. We also need to know the number of units in the development, 4, 5, 10, 15, whatever it may be. We need to know the number of those in that development to get an understanding. We also need to know what the as-is value is. It's the purchase. It may well be a purchase price if they're purchasing the site with a permit attached. It may be what the estimated market value is on an as-is basis. We need to know what that number is. And also, the developer may have already got a loan against this block of land at the end of the day. So we need to know not only the estimated market value on an as-is basis of the land, but what is there any current debt outstanding against that land. Of course, we also need to know what their estimated value on completion is going to be. What do they expect the sales revenue if they sell all these apartments, townhouses? What do they expect it to be? Construction costs, of course, very integral. We need to know how much is it going to cost to build the 4 units, 10 units, whatever it may be. What the term required is, and that is basically, okay, how long is it going to take to build the development? How long is it going to take to get council sign-off, statement of compliance? How long is it going to take post completion of construction to get the certificate of occupancy? And how long is it going to take to get strata titled, and so you can get the individual titles for each of those properties? So to do that, we'll need to know the term of that. And of course, we've got our own views. Our average term we find on construction nowadays is probably minimum 15 months, sometimes up to 24 months, depending on the development. So 15 months is normally our minimum term. And so, of course, we need to know what the term is so we can work out our calculations. The final one we need to see, of course, is pre-sales. Now, pre-sales are very important. You know, we're okay with some nil pre-sales. Some pre-sales, of course, we're going to need, especially for the larger loans. So that's what you need to provide to us. So just workshopping a quick scenario here. 4 townhouse development in southeast Melbourne. The purchase price of the property is $1 million. The estimated sales value is excluding GST, we've been advised, is 2.62 million. And so at La Trobe Financial, for loans less than 2 million, we can lend up to 70% of the sales value excluding GST. And that is not to exceed 80% of total development costs. So at the end of the day, we're looking for a minimum of 20% equity to be put in by the developer, minimum 20% equity. We would not go over the 80% development costs, full stop. We've been advised that the construction costs are 840,000, the term 12 months, there's nil pre-sales for this development. So, funding table. We need to work through a funding table. Is this deal going to work at the end of the day? So at La Trobe Financial, La Trobe Financial holds 100% of the construction costs. We do not hold anything less. It has to be 100% of the construction costs, because if anything happened and we had to take possession, we need to finish off the development. We also hold a 5% contingency, which is 5% on top of that build cost. And that is in case there's any cost overruns at the end of the day. You may hit rock at the beginning, or there may be something else that happens that the costs have increased. So we always hold 5% contingency. We, of course, have to take out our establishment costs, which at La Trobe are from 1.5%, and of course legal fees on top of that. Capitalised interest, as I mentioned earlier, we hold 100% of that, and how we calculate that, as you can see on the slide, is as follows. We take the loan amount, the loan amount, as I've mentioned, I'll just quickly go back for you. The loan amount, 2.62 million in sales at 70%, gives you a loan amount of 1,834,000. So that's the loan amount that we can lend on this development. So if we look at that interest amount, so we're looking at the loan amount times 60% as a rough guide, times the interest rate, which at La Trobe under 2 million is 8.99, times the term, which is 12 months. And then that gives us an estimated amount of interest that we're going to hold for the term. Now, some of you will say, what's the 60% got to do with this? So the 60% is when we draw down funds for a multi-unit construction loan, the borrower only pays on the amount of funds that have been advanced. So if we do the initial drawdown, they get charged on the initial drawdown amount. As the loan increases, as we pay the builder for the works being undertaken, of course, we draw down more funds, and therefore they're not fully paying, of course, the 100% of the actual loan amount during that term. They're paying on the amount outstanding. And what we find at La Trobe Financial, and has been good for us over a number of years, is that 60% is a rough guide, is a good guide, and we find it actually works quite well. So those of you, and some other people do, I suppose, look at cash flows, etc. La Trobe, we're pretty basic. 60% always seem to work for us. So that hopefully that gives you an idea of how we work the interest out. With respect to, I'll just go down one line there. La Trobe Financial on an as-is basis, we only lend 65% on the as-is project-related site value of the land. So, and that includes the establishment costs as well. So if you look at this, $617,500 plus your establishment cost of 32.5 is 65% of that 1 million purchase price. So that's as far as we're willing to go against the land for a multi-unit development deal that construction is going to start pretty much straight away. In this specific deal, which is actually a specific deal, in some circumstances we can fund other development costs. For example, council contributions. Each developer will probably have to pay council contributions to the council to get their statement of compliance, consultants fees, project management fees, etc. So this deal worked out nicely. At the end of the day, the borrower, of course, had to put their equity in, which is in the form, in this case, and in normal cases, of the land. So that is a quick scenario for you on loans less than 2 million. So La Trobe Financial actually funded this deal, and because the loan was less than 2 million, we didn't ask for any pre-sales. There weren't any anyway. And this is under construction, and we already know that they've already obtained one pre-sale during the journey already. And so we expect we do expect our loan to get paid down. We take 100% of the net sales proceeds of each pre-sale. And if there's any residual, we may be able to help them at the end. So if I go through another scenario for you, this is on a construction loan that we've currently got underway, 10 townhouse development in Western Sydney. Again, information we needed up front. The purchase price was 1.62 million. The sales value of the 10 townhouses on completion, $5.5 odd million. And so therefore, at La Trobe, above 2 million, we go to a maximum loan to value ratio of 65% on the excluding of GST value. And that gives us a loan amount of $3.6 million. And again, that is not to exceed 80% of total development costs. Now, those total development costs, of course, are all outlined in the valuer's reports, and we use that when we review to make sure the total development cost is not exceeded 80. We also obtained information that the construction costs were 2.368 million. They anticipated a term of 15 months to commence construction, finish, get titles, etc. And they had already pre-sold 4 of the 10 houses for $2.2 million. So that's again, that's not too bad, because at La Trobe, on loans above 2 million, we look at a minimum pre-sales of 50% of our loan amount. So $3.6 million, we're looking for pre-sales of at least 1.8 million at La Trobe Financial. If you went to the banks, they'd be looking for pre-sales of probably 3.6 plus 4 or 5 million of pre-sales. But at La Trobe, 50%. So we've got that information given to us by yourselves, and that gives us information we need. So we therefore, again, put a funding table together at the loan amount of 3.6 million. We take into account, again, 100% of the construction costs, 2.368 million, are held by us in the loan, for the loan. Another 5% contingency on top again, in case there are any cost overruns, 118,000. The establishment fee, again, we hold that. Of course, we take that at the initial settlement from 1.5% application fee plus legal costs. Interest, again, as we work out, we take in the loan amount, the 3.6 million, times that 60%, times the interest rate of 9.95, which is the rate we charge for greater than 2 million loans, and the term of 15 months. And that's given us capitalised interest, or an interest budget, that we will hold for this term of 269,000. So there is amount left of 787,300. Now that is a balancing item. as I've mentioned, Latrobe needs to hold 100% of the build contract, plus a 5% contingency, plus our fees, plus interest budget to cover the interest for the term of the loan. The difference between all those 4 items and the total loan amount is the amount that we can lend at the initial settlement to go towards the purchase of the land in this case, or a refinance, depending on if they've already got a loan. For example, if they had a loan already against this one of $1 million, for example, then they're going to be short and they will need to put more equity into the deal. This deal is a deal we've got on the go. It's a purchase amount. So therefore, we can lend $787,300 of the $1.62 million purchase price. The equity contribution that has to be put in this case by the developer, is the difference, the $832,700. That's the difference between the purchase price and what we can lend at the initial settlement. And of course, they've got to put in the $832,700 plus all, of course, the stamp duties, etc., on top as well. That's where they need to put their equity. All developers, borrowers, have to put their equity in up front at the end of the day. And we hold on to the remaining items as I've outlined there below. So when you are coming to Latrobe Financial you've got a scenario, that's the information we're going to need to help you and let you know if we can or cannot do the deal at the end of the day. You need that information to provide. If you can provide the information easily to us, we can get back easily to you on what we can do. So, development feasibility. The development feasibility, this was one done by a valuer of ours recently. And just to go through some of the items, the major points for you, the valuer obtained the figure there right at the top, the gross sales revenue. That is this 10 house development deal at what their estimated each unit will be, 581,500, to give a gross sales figure of 5,815,000. They then deduct GST, and we will lend on an exclusive of GST basis. As mentioned, this case max LVR of 65%, not to exceed 80% of total development costs. Then there are a number of cost items there. Purchase cost of the land, acquisition, construction, professional fees, statutory fees, interest expenses. So you've got the sales figure, you take all the costs off, and then that shows you a net. So down below the dark line there shows you a net development profit, 903,040. And that in this case gives a development margin of 19.97%. That's above our minimum requirement of 15%. So again, this deal looks profitable around that 20% margin area. And then you'll see just below that, if you can read 4, the residual land value. So as I mentioned on the project related site value, the residual land value, you take all the sales revenue, you take off your costs, you take off your profit, and the residual land value is the value of the land with the specific permit in place to do the 10 townhouse development. So I know we go through it a bit quick, but again, when you get a copy of this, it's the sales revenue less GST is what we lend against. You have to take into account all your costs. You get the net development profit, which has to be a profit margin above 15%. In this case it is, and it gives you a residual land value as well. So that is what a feasibility looks like. You may well find that developer borrower has already prepared one for you. We of course get the valuers to prepare one for us, a third party of course, looking after the financier's interests, and they look at, and that's why they prepare this for us, most integral part for any financier. So, Latrobe Financial, why come to Latrobe Financial? Okay, I suppose product flexibility is absolutely it. 70%, as I mentioned earlier, on loans less than 2 million. We can go to 70% of the on-completion value excluding GST. And for loans above 2 million, we go to 65% of the net realisable value, which is the sales value less GST. We go up to 80% of total development costs. A lot of financiers are much less. A lot of the financiers are actually much less than that 80%. A lot of them around that 65, 70. Some may be going a little bit higher, but not many would be in the 80% total development cost range. Latrobe Financial is. You'll also find, if you go through some of the major institutions, they will only lend in one line value. So earlier we looked at that 10 million, that 10 townhouse construction deal. They will only lend. They would get a valuer. Our valuer does it on a strata value basis. So they go 10 units at the 581,000 on a strata basis. So the individual 10 units, what do they all add up to? That's what Latrobe lends against. What you'll find is the banks always, in most circumstances, look at the in one line value, which is, what is the value if we sold all 10 of these not strata titled in one line? So there's a fair bit of a difference there. You might find there's a reduction of anywhere from 10, 15% in the value. So the next point, pre-sales. Up to 2 million, as we discussed earlier, nil pre-sales. I don't know any bank would lend nil pre-sales. We do on the smaller loans up to $2 million. And above that 2 million range loan amount, 50% of our loan amount has to be covered via pre-sales. So at Latrobe Financial, 80% of total development costs. That is better than you'll find in the major banks and a lot of other financial institutions. Some do it. Our ratios on our LVRs is against the strata value of each individual property, not on an in one line basis. We also are very liberal on pre-sales. Nil pre-sales, as I've mentioned, up to 2, 50% above 2. We also, as I've mentioned earlier, lend to developers and registered builders. Now, the banks probably call that owner-builder. We call it a builder-owner. But we are happy to look at some of those deals as well. So there's a lot of, I suppose, flexibility, different things that we're willing to do at Latrobe Financial. And that's why this proved to be a very successful product to us. With, I suppose, the banks cutting down and a bit stricter in the type of lending they're willing to do in this area of lending. So again, there are a lot of differences that we're willing to do. And, you know, as I say, if you've got the types of deals, please come and give us a try. Direct access, why people come to us again? Direct access at the end of the day. Direct access to the people who make the decisions. At Latrobe Financial, we do have a number of very experienced lenders in this area of construction who have done plenty of these deals day in, day out for many, many years. They can give you quick decisions on what can be done with respect to the deal. You can provide the information I've gone through earlier. We can actually provide, we can get back to you very quickly on what we can do. The team is easy to deal with, and easy to deal with because we know what we're talking about. It's easy, we understand. Provide the information to us, we can come back to you. We can educate you if required, exactly what we're doing today. We are educating you, and the credit analysts, the BDMs, they can always, they know their products, they know this product in and out, and they can help you push through and make life easier for your customer, who is the developer at the end of the day. And as I mentioned, speed to market, we can give you an idea within 48 hours if this deal is going to work or not. We also have a progress payment team. Very important, the progress payment team, because at the end of the day, the builders want their money quickly. So they put their claim in, we want our money. If we can get the money to them quickly, they can continue on construction and not hold them up, and they can build quicker, as we go on. The last thing at the Latrobe we want to do is hold up progress payments. So we quickly instruct a valuer or our quantity surveyors. They will go out, do their work for us, come back to us, and within 24 hours, the builder will have his money. Developer, of course, got to prove that, but the builder's happy. With the builder's happy, the developer's happy, we're happy, we can get things done quickly. So, our process, as we discussed, workshop the scenario, we'll send you the quote. You then need to lodge the application, and I'll go through the next slide. We'll just go through the documentation we need. We'll do an initial assessment for you, which of course includes the credit history of the borrower, the developer. Serviceability, does the loan need to be serviced? And we'll go through that in a second. If we can proceed, we'll and happy to proceed on the information you've given us in your application that you've lodged. We'll issue an indicative letter, and that outlines maybe some more information that we will require. Of course, a valuation report will be one, and a quantity surveyor report will also be one where it exceeds the $900,000. It may also require, if it's a refinance, statements on, so we can see the track record of how they went with their current loan. So there are many things that we may require. That will be outlined in our indicative letter. If the customer, the developer, will send that to you, you go to the developer, here's the indicative from the Latrobe. If you're willing to proceed, then we move on and obtain a valuation report and a quantity surveyor initial report. They normally take, for your multi-unit developments, you'll find valuation and QS reports normally take anywhere from 5 to probably 10 to 12 business days, 1 to 2 weeks to prepare. You then, if you've got other stuff that you need that we've outlined in the indicative letter, you send that back to us. So by the time the valuation report and the QS initial report come back, we can then proceed straight to formal assessment of the deal. So we have our experienced credit analysts will assess the deal. If they're happy to proceed, everything is okay with the valuation, everything is okay with the QS report, all other items, credit history, serviceability are all fine, then we get the loan approved and move on to issue a letter of offer, and the legal documents are issued by our solicitors. Those documents, of course, are sent to the borrower. They sign them, independent legal advice, etc. is obtained. All in order, we proceed to the initial settlement. So we draw down the money. The initial settlement will be for the land and the establishment cost. All the other costs will be held by us and drawn down during the remainder of the term of the loan to cover the build costs and the interest capitalisation. We monitor each project. Each project is monitored. We have a few hundred on the go at the moment. I have a team that monitors every development. If we see someone's running a bit late, haven't done a drawdown for a couple of months, we'll be on the phone to them to find out what's going on. We like yourselves to be part of the journey with us in these construction loans, not just to done the initial settlement. Normally we like you to be involved in us during the journey as well, to assist us if there's any issues with regards to the build, etc. And again, those progress payments are paid very quickly here at Latrobe, so we can keep the builder moving along. So what documentation do we require? Our normal La Trobe financial application form. We want a resume of the borrower, the sponsor behind it, to see what sort of developments they've done in the past. We'll also require some financial information, whether it be on a full doc or a light doc basis. Verification of identity, of course, is a requirement. We'll also require, of course, the council approved development approval permit and any stamp plans, again stamped by the local council with regards to the specific development. We want a copy of course, the fixed price building contract, a resume of the builder, because we want to make sure that they can actually build the type of the construction that they're being asked to build, a resume of the project manager if applicable. Now, project managers normally you'll find are for larger type transactions. So developers are developing, but they also employ project managers to manage the build, the process with regards to the council, etc. So if one is involved, we'll require a resume of that project manager as well. So that is the documentation we require. Again, sort of the same information we require for any other deal, app form, for a light doc, verification, but specifically for construction, resume of the developer in this, the borrower who's developing. Have they done this before? It's not new. Council approved permits, building contract, resume of builder, project manager. Final slide from me is, yes, we've got an interest budget as part of the transaction. And so therefore, the loan doesn't need to be serviced during the construction period because we've got that interest budget that we're holding. However, if we agree to a nil pre-sales loan for construction, La Trobe Financial, we've got to look at once the completion of construction, we've got 4 of the units remaining. They're not sold. So therefore, if it's a 4-unit site and the loan is 1.5 million, we need to service 1.5 million at the end on a nil pre-sales amount. So what we do is, that's why we need to get the full doc and the light doc information, because we carry out a standard serviceability assessment, the Trobe standard serviceability assessment, using the full doc or the light doc information we have been provided. We also take into account the rental income. So if there's 4 units being completed, we're happy to take into account the rental income on completion, what the rental income is for those completed 4 properties. We will of course take into account, we've seen their asset and liabilities, if there are any other liabilities they may have that they're paying for. We do a normal standard serviceability, and if there's nil pre-sales and we lent a 1.5 million construction loan, we will need to service it on $1.5 million. We don't service it at the construction rate of 8.99, of course. We service it on our investment rates at the end of the day, 5%, 5.5, whatever our investment rates are at the time, we will service it on the investment rate. So it's the full amount, standard serviceability, using our investment rate at the end. Now, if there's pre-sales attached to the development, but they don't fully, of course, pay out, so it's less than 100% pre-sales, we again follow our standard serviceability assessment on a full doc or a light doc basis. But what we do, again, we're happy to use the rental income from the properties that are completed on top. And what we do is we service the loan amount less the pre-sales. So again, if we had a 50% pre-sale deal and the loan amount was 3 million and we had 1.5 million of pre-sales, we service the loan at the end on $1.5 million, which is the less of pre-sales amount. So we do our standard serviceability, the lesser amount, again at your investment rate at the end, not at the construction rate, which in some of the larger deals would be 9.95%. I hope That's given you a bit of an overview of construction lending in the short period of time that we've had. I know there's a fair bit to it. I'd like to thank you for listening, and I'd just like to hand over to Corey Bannister now, tell you what to do next.
Thanks, Steve. Great presentation. And once again, just thank you all for your participation. The amount of questions we've got coming in is phenomenal, and we will come back to you each individually. We've tried to keep up as best we can during the webinar, but there's just too many to answer. So Steve or the team will be in response to that to you shortly. What to do next? We just wanted to mention that in terms of accreditation, we are slightly different as well, in that if you have La Trobe Financial Accreditation, which is often taken care of by way of your accreditation through your aggregator, you're accredited to write any one of our products, whether it's residential, commercial, self-managed super fund, construction. They're all available to you immediately. In terms of training requirements, there's no formal training requirement or test that you need to pass to be able to write any of our products. However, we do recommend that if you want additional training or you want to workshop a scenario, by all means, please contact your BDM or even anybody here on the credit desk. We're happy to help you and workshop transactions along the way. And then lastly, as I mentioned, reach out and speak to your BDM if you want clarification around any of today's points. Our senior manager client partnership team are all credit skilled and can help you in this area, but if for some reason they can't, they'll absolutely find the answer for you. If you're unsure who your partnership manager is, please call us here at the office and we'll put you in contact with a relevant partnership manager for you. They're only a phone call away. And lastly, we would just encourage you all to get started. So we hope this, as Steve said, we hope this has been of value to you. We may even do a follow-up session to this in a month or so and just work through some more workshops and case scenarios. I think they're often the best way to really embed that knowledge. I know we've walked through it fairly quickly today, but if the response is good, then perhaps we run another one and we really take some time just to pull apart a feasibility analysis and go through the numbers with you in more detail. But thanks again for listening. Thanks for your questions and your participation, and we really look forward to working with each and every one of you shortly. Thanks very much.